Guys, turns out I just learned that I don't exist. So I wanted to give you my unfiltered reaction to this video from Dimitri Bianco here, who made a 10-minute argument about how it is practically impossible for independent quants to make it on their own and essentially leave the rat race if they want to make a living. So as you might expect, as an insider looking out, I have a thing or two to say about that. So grab yourself a cold one, sit back, and let's hear what Dimitri has to say here. Before we start, I want to say that this reaction video is not a personal attack on Dimitri. As you know, I was in the asset management industry for about 17 years total before I bounced, and what I heard in this video is by and large the carbon copy of the same formatted rhetoric that I heard from naysayers who were my professional acquaintances at the time. So what I am going to comment on here is the rhetoric, not the person. I promise I'll try to hold my horses and not interrupt him every 10 seconds, and as I said, I'll try, but don't hold me to it. Okay, so let's hear it.
Hey YouTube, it's Dimitri. Today we're going to answer a subscriber's question, and probably one I get a lot and somewhat I would like to debunk a little bit.
Oh yes, go ahead Dimitri, debunk me a little bit.
The question is, can you be an independent quant, or do all quants work for firms? So yes and no, and it's a challenging question, but my typical answer is no, you cannot be an independent quant and be fairly successful, which shocks people because we start to look back at historical quants or, prop trading firms and we go, wow, they made millions and millions of dollars back in the 80s and 90s. And maybe early 2000s before the 2007, 2008 financial crisis. So therefore, all of us want to go out and get a financial engineering master's or quantitative finance master's, and we're going to be millionaires. And the beauty of all this is you don't have to work for anybody.
Yes, that's exactly the type of degree that you should at least get to in order to be able to do some math that stretches beyond linearity and basic statistics. That'll keep you from magical thinking, drawing on charts, seeing patterns everywhere, and deluding yourself into believing that you got a trading edge from it.
So let's run through a scenario here why this doesn't work out in practice. And I will note and put a little caveat, I am sure there are some anecdotal evidence here. There are one or two people that have done it.
See, I don't think that this caveat is genuine. As I said, I am extremely familiar with that very mindset from when I was an insider, and this caveat is just to cover his bases in case a mofo like myself could prove his theory wrong. But deep down, I know the cozy brainwashing and the domesticated culture in the industry for having been exposed to it firsthand for way too long. And it is that becoming independent cannot be done, period. And I'll explain to you why that thinking is the way it is in a second, but for now, let's have him continue.
But let's go through the math a little bit from a quant perspective. So, let's hypothetically say you have $1 million. I just gift you $1 million. You have $1 million and it's just sitting in your bank account. Okay. It's $1 million. And you're going to make 10% on that return in the first year.
So, I would agree that 10% annual return is a reasonable assumption from him. It's on the low end, but reasonable. I would say 10 to 20% annually is the range that you should aim for, assuming of course that you care about managing risk, which, truth be told, if you don't, you should probably remain fastened to your cushy corporate cubicle. You have to keep in mind that as an independent trader, there is no reset button. Your capital is all you have, and once it's gone, and nobody's coming to save you. So risk management better be an absolute priority, and as I keep saying it, regardless of what your wonderful backtest says, it's gonna be hard to actually go past a MAR ratio of 1 to 1.5 in the very long run. I'm talking decades here. Now, of course, you're gonna get the clueless morons in the comment section explaining to you how 10% is ridiculously low and how they are way too good to settle for such low performance standards. Look there, I found one. See, so yeah, becoming independent definitely means abandoning the retail mentality of dwelling on that return-focused pissing contest and risking a margin call with every single trade on your $500 micro CFD account. I think it goes without saying, but from reading the comment section, apparently not. Anyway, moving on.
So let's just do simple math here. $1 million times 10%, you made $100,000. So people are like, oh man, Dimitri, that is awesome. That is amazing. I made $100,000 and I don't work for anybody. Well, that's assuming you pay yourself nothing. That also assumes there are no costs associated with the trading. We're just going to pretend transaction costs disappear. We're going to pretend the computer, the internet, the time, the textbooks, the learning, all that stuff just disappears.
These costs are a cop-out. Let me explain. As I described in this video, the buy-in amount to acquire the equipment and resources to trade for a living is extremely small. Literally $5,000 tops if you remain realistic. The drawback of that is that such a low barrier to entry makes it so that the flush-out rate, in other words the failure rate, is equally extremely high in trading, as you all know. But that's not the point of this video. My point here is that costs are mostly a non-factor. Broker commissions are dirt cheap nowadays, and including if you don't go for a free broker, which, as you know from my courses, I urge you to avoid like the plague. I mean, look up the commission rates with interactive brokers or an ECN broker. We're literally talking pennies that won't make a difference unless you stupidly try to scalp the market like retail loves to do. As for your data, we're likely ballparking a few hundreds per year maximum, and the internet, well, I think it's pretty safe to assume that the reason why you're watching this video is because you already have the internet anyway, so that does not even compute into this equation. But let's keep going.
And we're gonna say you made $100,000 and you paid yourself nothing. Now, you could rewind this back and say, okay, Dimitri, let's say I'm really smart, I can get 10% return, which, as a note, that's more than the market average here. So market average is between like 6 and 8% with well diversification. If you're really smart, you might be able to knock in a 10% return here. So let's just say you can do 10% and you take $100,000 every year. So you have $1 million somehow, which we're not going to ask questions how you got it.
Well, how you got that $1 million in capital is pretty simple actually. Not easy, but simple. How so? That's called sacrificing, living frugally, saving, and remaining locked in on your goals when others are partying or prioritizing other things.
But you have $1 million, you can generate $100,000 a year, and you pay yourself $100,000 a year. If you can consistently do that, you would make, yes, $100,000 a year. Now, when you looked at the two videos, which I'll link above or below in the description, quants can work for firms making $100,000-ish to start.
Now, here it comes. Listen to that part very carefully. I'm just going to interject here and still bring up the obvious that 100 grand is literally just above poverty level in New York City, but okay.
Now, the beauty of not working for yourself is you get paid your salary regardless of performance. That's what a base salary is. So you can start at a job, you could do sell side like me in risk management, have low stress, regular hours, work 40 hours a week, have great benefits on top of all this, which they don't include inside that 100 grand.
There, as you can hear it, the counter argument to whether you can become an independent quant is shifting. Now it no longer is so much that it cannot be done, it has become that it's less convenient and comfortable, and the argument is always the same: unconditional pay, low stress, regular hours, vacation time, health insurance, benefits, basically the appeal of post office mentality.
And you can get paid, you know, 80 to 100,000 to start, and within a few years you're probably making 120, 140, depending where you're at. New York City, you should be making a bit more. Other places where it's cheaper to live, you'll be making a bit less. But in general, you're making 100 grand with essentially no stress or minimal stress because you're working for someone else who has to deal with all of that. Now, this also assumes the fact that you somehow know how to set up a hedge fund or a prop trading firm.
Setting up shop is not that complicated if you prepare yourself well in advance. That is precisely what I'm alluding to when I mentioned putting in extra work at home after office hours for yourself to become proficient 360 degrees at every aspect of asset management, including regulations, accounting, etc. Now, if you've done that, you would know that shopping for easy to set up jurisdictions is a major part of the process of setting up a firm if you wish to do so. Now, newsflash, nobody forces you to live in the West, but once again, we're talking about comfort level and convenience.
You also know how to go through the proper regulations. You also have free data to you. There's essentially no cost associated with this. So, you know, you can see here, if you made that 10% per year at $100,000, it's more lucrative, less stress, and easier to actually work for someone else than it is to say, okay, the 10% is not guaranteed. I have to perform and I have to do extremely well. And if I don't do extremely well, I might not get paid. So you might make, I don't know, say 6% for the year, which is about probably market average, 6 to 8, but you're a little bit on the lower side. You make 6% a year. You're only making $60,000. And again, there's that risk associated with your performance here. So you can see it's more advantageous just in this scenario to work for someone. Now, let's pretend somehow, I don't know, your family's super wealthy. You got the $1 million for free.
There is no need to run to these idealistic extremes to make it work. Ask me how I know.
and you're going to compound that money 10% per year, right? That's what everybody likes to assume here. So if we take $1 million and we compound that out at 10 years at 10%, if my math is correct, you'll end up with $2,593,742.46. Now you got to subtract out your $1 million initial investment, which your family gave you or you borrowed or something else. That's not really a return. That's just assets you had. You take that out, you end up with $1,593,742.46. And now you divide out all that effort that you had over a 10-year period, and you end up with $159,374 and basically 25 cents when we round it up.
So as you can see, the math does check out in the end between independent and corporate. Surprise, huh? So at the end of the day, I guess you have to ask yourself, do you want to dictate the terms of your own life? Or do you want to remain a corporate cuck for the rest of your life? You pick one. But once again, it is not a matter of whether or not it is possible, but rather a choice between what is easy and comfortable and what is hard and out of your comfort zone.
$160,000 a year is a terrible salary for a firm. Like you could work somewhere 5-10 years into a career and be blowing past $200,000-$300,000, which we saw in the Carnegie Mellon report here. Again, you'll be making this towards some experience.
Speaking about experience here, what do you think you're going to get the most experience with? Your own venture or someone else's cubicle? What medium do you think is going to kick you in the balls the hardest to reach your full potential? I mean, think about it.
This isn't like you just waltz out and make tons of money off the bat. But you can see when you started, making around $100,000, 90, 100 with benefits and all that kind of tied in and everything for your base salary, it's much more advantageous and much easier to work for someone else in that scenario. Now, in the case that you don't need any money and you compound it and everything else, again, you're not making a whole lot of money. Now, the secret in finance, though, and why people end up starting firms and actually making millions of dollars, which we want to talk a little bit about, is they're able to scale this. So to scale this, in this scenario, let's say you could make 10% returns year over year and you could prove that you could do it. Now it's much more advantageous to run out and find investors to raise $50 million or $100 million or $200 million so that you can scale the operations to now make the profits much, much larger. And now you can pay your employees those, few $100,000, $250, whatever.
That's wrong. You don't need to scale your costs if you are full stack. You can just scale your capital base because you should be proficient at everything. Now, if you really want to outsource some tasks, once again, nothing keeps you stuck in a high-cost jurisdiction. You can expatriate yourself easily and find cheap, high-quality labor to do that job for you. That way, you will work less in the business and more on the business. But then again, it's a choice about whether you wish to abandon your comfort
in these ranges and get some new employees and train them, from about 100,000 up. And you can bring all this in and build a firm. But again, you have to go out and find investors. So again, doing it independently with no investors, no team, nothing. Sure, it might be possible. There's a lot of risk in it and a lot of people lose money and get nothing for the year. The expectation of returns, though, it is usually much more advantageous to work for someone else. Now, that being said, though, going through this scenario here where you go out, you find a bunch of investors. Well, now you're tied to those investors and now you have to report and deal with the investors. And now as you start building a firm, you're going to have more and more legal paperwork like FINRA you have to deal with because you have to follow rules and regulations. And perhaps you're in another country, as an example, and you have to do the same thing. Well, as these things start to scale, you'll start finding out too that your one strategy only worked for a short period of time. You have to come up with a new strategy.
Here we go. Massive red flag here. As you know from the courses that I published on this channel, there should be no need to drastically update your strategies over time, let alone change or swap them. If, and that's a big if, they are based on pure math. He's coming here from the flawed premise that algorithmic logic and quantitative edges degenerate and decay over time. Once again, and for the millionth time, it does not have to be the case. And honestly, when I hear this, I am now seriously questioning his actual skills in quantitative trading and his overall knowledge of the field in the capacity of a value creator as opposed to just support function.
And so now you start finding out you need to implement these things into automated systems and you need to have things set up. So you need data engineers, you need a quant to come up with the strategies and build out, the research portions of it. You need someone to execute this, which is typically like some sort of trader. And again, you needed someone to deal with all the investors.
Yes, I'm doing all of that, and that didn't kill me. And I also didn't need to hire a tribe around me to make it all work smoothly.
And you'll need a lawyer, and you'll need accountants. And as you see here, you'll probably need HR because now you have all these employees. And as these things start to grow, you might be, we'll put in air quotes, independent, but you're not independent anymore. Now you're just creating a firm. And a lot of quants end up doing this, where they go and they work for someone else, they make some good money, they have some nice financial cushion, they take their ideas, their information, their network contacts to hire really good employees, and they start their own firms, and they become profitable and successful in that notion here. So I hope you guys get from this takeaway here, it's not like this, I don't know why. This fairy tale exists where it's like, I'm going to go out and become really, really smart. And because I'm really, really smart in quantitative finance, I'm going to make millions of dollars. There's just a lot of ignorance in that ideology here and kind of that storytelling. And yes, it is very romantic. It would be amazing if you could just quit your day job, work for yourself, sit here like in an office like I am doing my YouTube stuff, but instead just be trading and making millions of dollars, and it'd be great and wonderful.
Well, guys, I'm living a fairy tale and a romantic lifestyle, I guess. Oh my gosh. Fucking hell. Talk about an epiphany today, huh?
The reality is, though, is one, trading is very, very challenging. Markets are very brutal. To be competitive, you have to have a lot of resources and a team behind you to do it effectively and efficiently. And there's lots of other costs and overheads that come into this on the firm side as well. So building a firm is typically where you end up with. There might be this romantic fairy tale of you starting your own trading ventures, and then if it grows and you are successful, it will turn into a firm. If you are not successful, it'll turn into you working for someone else. And so realistically, that fairy tale dream is kind of a tipping point where it's like you might start in that ideology, but you're going to end up either working for someone else or creating your own firm and having a bunch of people work for you. But in finance, if you cannot scale, it is not profitable. So that's why quants end up working for someone else. It's much safer. Or they work for someone else for a while and then start their own fund because they have experience, so they can gain investors here. So if you don't have experience and you're nobody, it's really hard to get investors. If you've worked in the industry for a while and you know a bunch of people and you can prove that you can make a profit, it is much, much easier to get investors here. So you're going to end up one of these two camps, either, working for someone else, which isn't all bad, because there's a lot of the risks associated with running a fund that you don't see as a newbie. And the firm takes care of all of that. They have people hired to do all that. They're experts in actually running firms and investment firms. And then on the other side, you might gain all that experience, gain a good network, build out your own firm and do it yourself. But again, you're not really working for yourself. You have a lot of investors you report to. You have employees and teams to manage and a bunch of other things that perhaps aren't as fun and exciting as building models and doing quantitative research. So anyways, thanks for listening. Thanks for watching. And as always, until next time.
So there you have it. As you can tell from me breaking down the true meaning behind this video, the main obstacle between working as a quant for someone and going independent, aside from acquiring a sufficient capital base of course, is much more related to how much comfort you're willing to give up rather than anything else. In fact, as a veteran in this industry, I can remember conversations with former colleagues who, by the way, never quit their jobs, obviously, and they all admitted what we would call, quote unquote, having our asses stuck in the butter, meaning that these jobs are warm, they're pleasantly rich, greasy and comfy, and basically a tremendous incentive, some may call it a bribe, to remain domesticated by the industry. The question is really less about whether it is technically possible to go independent, but rather if you want to take the adequate risks and test your limits to grow as a quant trader. If you don't have this mentality, I can guarantee you that the industry will do everything it can to make you stay, and you will find all the mental gymnastics required to prove them right. However, you have to be true to yourself and recognize that there's a price to pay for complacency, and that price is largely skill set stagnation, intellectual numbness, and just general apathy. Well, if that's you, then more for you, but that's certainly not me. When it comes to excelling at what I do, anybody who knows me or worked with me in the past will tell you I'm an absolute obsessed savage at what I do. Anyway, before I close out this episode, I will have you think about a point of detail implied throughout Dimitri's video, and please ponder this idea for a minute. If the so-called experts in the asset management industry that Dimitri is mentioning, meaning bankers, quants, traders, asset managers, etc. If they are so afraid about going independent, then what does that say about their actual ability to generate higher performance than the market, meaning the average of their own clients? I'll let you in on a little secret about why it truly is that so few so-called experts will never dare to go independent. And that's gonna be our bottom line here. That reason, that true reason, is because deep down, they know that they can't trade any better than their own clients. And having a fully variable pay tied one-to-one to their outperformance scares them shitless. Now, if that's the case, then does that still make them experts? Which so-called advice is worth paying for? Solve me that riddle. I'll talk to you in the next one.